Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research team. And in this episode, I'll be talking with our Global Economics team, with Rob Subbaraman, our Head of Global Macro Research, Lewis Alexander, our Chief US Economist, and George Buckley, our Chief Euro and UK Economist, on their thoughts for the outlook of 2021. I'll be asking them what they expect on global growth and inflation, what opportunities does the vaccine and the reopening trend present, and the main risks they'll be watching out for too. So, Rob, I want to first start with you and boil it down to the key components for all of us. Let's just talk globally first, and we'll zoom into specific countries as well. In your view, Rob, what is the path for global growth and inflation? Is it all smooth sailing?
Hi, Jordan. It's great to be here. I wouldn't say the global path for growth is all smooth sailing. So if I look in the near term, well, right now, we think this quarter, Europe is back in recession. And in the first quarter of 2021, we do expect double dips in GDP growth in the US and Japan and probably a few other economies. And that's clearly because of the resurgence of COVID. Looking at Asia, on the other hand, led by China, handled COVID a lot better. And we think the recoveries in most of Asia will continue without double dips. So that's more smoother sailing in Asia. I would say, though, that in the second half of the year, we do see the global expansion becoming more synchronized. So with the vaccines, US, Europe actually start recovering again. Asia's still recovering. And so we have this synchronized recovery in the second half of the year. But again, I wouldn't say it's all smooth sailing because there's risks. One is geopolitics. We think US-China tensions. There might be a honeymoon in the first half. Second half, they could rise. There's also financial stability risks. And there's also emerging markets. We think there's going to be growing discrimination in the second half. On inflation, we do think it's going to stay low. And that's because the output gaps are still going to be big. I mean, the reality is, even by the end of 2021, most economies are still going to have real GDP lower than 2019. So inflation low, but by second half, synchronized global expansion, low inflation, but there are these risks I talked about.
The risks are something that is the great unknown, especially if we had some sort of wave of credit defaults. Every general is ready to fight the last war. We had the global financial crash lead to the euro crisis. Does it lead to another euro crisis? That's an open question, but there could be crises elsewhere. I want to ask you now more about the vaccine impact and reopening. So we're dealing with this awful winter of a high number of case growth in the US. Europe's in the potential state of, continual state of lockdown, essentially, and rolling lockdowns up and down. But next year, if the vaccine's rolled out, Rob, and we do have a reopening properly in the spring and hopefully, fingers crossed, back to normal from the summer onwards, it's been described as the everything rally, where most asset classes, most countries should outperform. But I want to differentiate a bit. There'll be some countries that might underperform others. Which countries and regions do you expect to outperform and underperform, Rob?
That's a great point. The vaccine, everyone thinks it's the, excuse the pun, but cure for everything. Firstly, I would say the pivot point for the vaccine, so the point where the vaccine is quite substantially inoculated by people. We see governments really unrolling all the restrictions and basically citizens become less fearful. We think that vaccine pivot point is the second quarter of next year. So it's still some time away, right? We're in December now. And that, when I say second quarter, that's for the advanced economies mainly, where they will be getting the vaccine quicker than emerging markets. So you're exactly right, Jordan. When you're looking across the world, there will be economies, and I would say particularly emerging market economies, which aren't going to get the vaccine as quick. They've got huge populations. It'll take longer to inoculate a large share of them. Their pivot point could be later. And for an example, in Asia, countries like Malaysia, the Philippines, Thailand, we don't think the pivot point for the vaccine, where there is a real growth reacceleration, happens until the fourth quarter. Final point I'd make on vaccines is watch out for vaccine diplomacy. I think with the vaccines, the risk is some countries get it before others. There's going to be, I suspect, geopolitical issues around that. There could be discussions and concerns about hoarding by some countries as well. So vaccine, it's great news, but I think it's going to dawn on us that there's challenges in actually getting it all implemented.
Well, let's talk about that, how that impacts the sort of policies that we might see next year. So there's definitely challenges. Vaccine is not the cure for everything, as you put there. So we've had a crazy year of 2020. We've seen yield curve control in Australia. We've seen the Fed adopting average inflation targeting, the ECB introducing PEP. We've even seen countries such as Indonesia adapt helicopter money sort of policies, you could describe it as. What's 2021, Rob? Do we see more monetary policy innovation? Do we see the opposite? Do we see central banks trying to raise rates, dealing with the potential wave of inflation we could see thanks to the base effects? And what about fiscal policies as well? My main worry next year is that we hear the words from policymakers, we've done enough. And that could really weigh on markets if you saw fiscal stimulus dry up next year.
That's exactly right. And, I think the danger is that the scientists win the war on this COVID battle with the vaccines, but policymakers actually lose the battle and we slip into recessions again. So I think that's actually dawning on Western politicians right now, that the reality is we have a very uneven recovery, right? The bottom 1/3 industries hit hardest by this virus are really struggling, and now we have a resurgence of the virus. I think it's becoming clear with the economic data that politicians realize that, geez, unless we do something, we could have a wave of bankruptcies and it could spiral. So I think we are going to see more stimulus very soon. So the phase 4 US fiscal stimulus. I think Europe is going to do more. Japan's just announced another fiscal stimulus. And then central banks. The reality is, as I said, inflation, at least in 2021, we think is going to stay low. So they also will err on the side of doing more easing than less. So I think, bottom line, I think policy is going to stay loose. And it's really because the economy is so uneven. GDP is not a very good gauge of economic health anymore. You've got to look deeper. I think policymakers realize that. They're going to keep policies easy until we have a sustainable recovery. And that's still some quarters away.
Well, then we've got COVID-19. Hopefully, vaccine cures that in terms of dealing with lockdowns. We've got potential for fiscal and monetary policy to remain supportive, if that's the case. Are those the two main macro themes, or are there a few others on your mind next year?
Well, if you ask me, Jordan, what is the biggest kind of macro risk to Nomura's outlook? I would say without hesitation, by far the biggest risk to our view is we get a surge in inflation. And I'm not saying so much, I don't think so much 2021, but I think it could be as early as 2022, where we get a decent surge in inflation, maybe 5% or even higher. And of course, markets are forward looking. They're going to start to be pricing this risk maybe second half of next year. That's my biggest concern. And let's face it, the reality is we have had unprecedented policy easing. And it's going to be hard for central banks to kind of exit. So firstly, they've said that they're going to let inflation run economies hotter. So we could easily imagine a scenario where inflation, gets a bit above their targets and they're not reacting quickly to it. But then the challenge I see is the world is awash with debt. And maybe central banks will be slow to raise rates even further because of the debt trap. It could cause another recession if they raise rates, or maybe governments will actually put pressure on them not to raise rates. So they could, it could be a slippery slope where they fall further and further behind the curve. So inflation to me is the big risk for our view, and I think particularly markets in 2021.
Is there anything in your mind, Rob, that we should look out for in terms of risks? I think we've talked about inflation risk there. But is there anything over January or February particularly that you'll be watching out for?
Well, I think in the near term, probably one of the key risks is what happens with the Senate runoff in Georgia. Markets are, quite of the view that the Republicans are going to hold the Senate. If that turns out to be wrong and the Democrats get a full sweep, it will be quite interesting. It will be a big, I think, change in market thinking, right? On the one hand, we could get a lot bigger fiscal stimulus from the US administration. On the other hand, there could be concerns about the Biden camp pushing through higher taxes over time and tougher regulations on tech and the banking sectors. And that could actually make it quite volatile times for markets early next year.
Absolutely. January the 5th, that runoff. I'm going to be asking Lewis Alexander all about that just coming up. Rob, in just a few words, how would you conclude and how would you summarize next year?
Well, I was thinking about this, and I would summarize by saying it's going to be a topsy-turvy recovery in the sense that we expect a low inflation, global synchronized expansion in the second half of the year, but juxtaposed against that is very high income inequality, geopolitical tensions, financial stability risks, and high debt. And as I said, that risk that we do get a surge in inflation in the medium term, and markets really start to focus on it.
Well, there's a few meanings for the word topsy-turvy, Rob. It means upside down. It means placed upside down. And I think the noun version is quite impressive. It means a state of utter confusion. And so with that said, thank you, Rob. That's a wrap there.
Thank you very much, Jordan.
Let's bring it to you now, Lewis, and zoom in on the US outlook for next year. We're recording this with the Fed still to come up next week. US fiscal stimulus, phase 4, it's still up in the air. I want to talk a little bit about that, but I also want to talk about the factors for 2021 as well, rather than the here and now. We've got the January 5th Georgia seat runoffs and a new administration with President-elect Joe Biden and more in store for next year. So with all of that in mind, let's first tackle the January 5th runoff for Georgia. And then I want to talk about Joe Biden's administration. So Lewis, what's the view on the Georgia seat runoffs? Can the Democrats squeeze it?
So it's possible. Obviously, Biden just won the election in the state of Georgia, which suggests it's pretty close. But typically what happens is Democrats don't come out as much in non-presidential elections. And so the fear is you're going to see a big decline in Democratic turnout, a larger decline than you will see on the Republican side. So the Republicans are favored. I think it's also true that the election results suggest that an awful lot of people were voting against Trump. And since Trump's not going to be on the ballot, that's probably another motivation that's taken away from that. Look, Georgia is still probably a Republican state by its natural partisan lean. And so I think the right assumption is that the Republicans are going to win at least one and probably both of those seats.
If the Democrats win Georgia, or if they don't win Georgia, how does that feed into your view on what Joe Biden's administration will look like? I think we have to talk about the two differences.
Sure. It's quite important. It will affect control of the Senate. And that's important both in terms of process things like controlling who comes up for a vote, which is important for filling all those positions that need to be filled with Senate confirmation seats and whatnot. But it also creates the possibility for doing more legislatively. more fiscal stimulus, potentially tax increases. There are a whole variety of things that are possible if the Democrats control the Senate that probably aren't if they don't. So it's a reasonably big deal. Now, I do want to stress that the best the Democrats can do is 50-50, and they would have to rely on the vice president to break ties. That's a very narrow margin, and the Democratic Party is not a uniform thing ideologically. And so two of the Democratic senators are Joe Manchin of West Virginia and Christian Sinema of Arizona. They're both from states that are, frankly, lean more to the right. That will be a constraint on Biden, even in a case where they have a majority. So the best the Democrats can do is be in a position where they have some potential to do some of the things they want to do. It will definitely make a difference. But you should not assume that just getting to 50 seats is going to allow Biden to do everything that he laid out in the campaign. Because frankly, some of that stuff you're not going to be able to do with that narrow a majority.
Well, let's talk numbers then. So if the Democrats don't win Georgia, what's the dollar number that you expect for fiscal spending next year, let's say, or perhaps for the next 2 or 3 years? And if they do win Georgia, is there a massive difference between those two numbers?
Well, what we've written is we think it is a fairly significant difference. It's probably $1 trillion in COVID-related additional support for COVID-related issues, and a substantially larger infrastructure bill. So we do think those numbers are material in terms of those differences. But for example, on the infrastructure bill, Biden had laid out a $2 trillion deal that was focused on climate change, among other things. Joe Manchin is from a coal-producing state. He's probably not going to sign up for that. So while I think he will definitely get more infrastructure investment if the Democrats win both those Georgia seats, you're probably not going to get the kind of majority that is going to allow Biden to do all of the things that he laid out in the campaign. So, a significant increment on the infrastructure side, but probably not quite as big as they had laid out.
What can Joe Biden do? What instantly pops into my head is foreign policy. And we saw that with Donald Trump, executive orders. Mm-hmm. What sort of executive orders could we see? And regulations as well. Is that something that needs congressional approval? Or is there regulations that the president can do?
So there's a lot a president can do on the regulatory front. There's a lot of regulatory discretion. You saw Trump do that in a variety of ways. And so I do think there are some important things, like, for example, labor regulation in general has sort of lapsed under Trump. This is obviously important to unions. It's relevant to things like the capital labor share of income. Those are things that we would expect under a Biden administration to be reinvigorated. Another area is antitrust regulation. That is something which is in some sense under the control of the Justice Department. So there are a lot of issues related to big tech and all those kinds of things that can be done without legislation. There's no question that there are some things that require legislation. So for example, on the financial side, some of the more extreme proposals you've heard for things like going back to the Glass-Steagall segregation of investment and commercial banking, that can only be done with legislation. So a set of Biden appointees that will be more like what you had under Obama will put financial regulation back on the track it was at the end of the Obama administration, which is basically implementing Dodd-Frank. They will be able to, in some sense, reverse some of the changes that have been made in the last 4 years. But you're not going to be able to probably go to some of those more significant changes that would require legislation. So you can do a lot with regulation. You can do a lot with executive orders. Things like, say, for example, on immigration. Obviously, one of the things we would expect is to essentially go back to where we were on immigration under Obama, which did, among other things, give children who are brought here by their parents illegally, give them a way to normalize their status. This is the so-called DACA issue. Biden's already said he's going to reinstate that. That is something he can do with executive orders. So there's a fair amount you can do, but there are limits as well.
A lot of the questions I've had from clients over the past week is the short dollar, long euro trade is quite consensus. The back to normal, everything rally trade is quite consensus, but thanks to this vaccine. So instead of focusing on that, a lot of the questions I've had from clients is, how can it all go wrong? So they're very much used to a few Januaries and over the past few years, where whatever the narrative is of December completely changes, briefly at least, in January. And it times quite well with the fact that you had, when Trump, for example, won the presidency, 2016, we saw the big reflation trade. Early 2017, when he became president, the market was quite disappointed that he focused on healthcare first and Obamacare repeal and replace, I remember, rather than tax reform. Lewis, is there going to be some sort of disappointment or negative surprise from the early focus of Joe Biden's administration? I'm just trying to get a sense of what's the first thing you think that his administration is going to focus on.
So, look, the first thing they have to focus on is getting control of COVID-19. It's resurgent in the U.S., and that has to be the biggest issue. That is, I think you will see a more regular, well-articulated response, and that will, I think, be reassuring to people. But there are limits on what you can do, and so, like, that's issue number one. Issue number two is the economy. And so those two issues, which are obviously related, are going to be the things they're going to focus on first. My biggest concern for a negative surprise is partisanship and how big a constraint that's going to be going forward. In 2010, 2 years into the Obama administration, the Republicans took control of the House under the Tea Party. And that began a period that was very contentious, where fiscal policy was outright contractionary for several years and was very much related to why we had a very slow recovery coming out of that very deep recession. I think the risk is this time is that those dynamics happen almost immediately. It is our expectation that we are going to get another fiscal bill within the next couple of weeks before people go away for Christmas, but that may well be it. That may well be the last thing we get. And so I think one of the things people need to be mindful of is that the partisanship and the constraints that that's going to impose could be a bigger deal than people realize. So that's one issue. There's another issue which relates specifically to China and really the U.S. relationship with the rest of the world more generally. And that is, obviously, Trump was very disruptive, and there's a kind of a sense that people have that surely whatever it is under Biden, it's going to be better than that. And I think that's right. Biden will be more normal in the way he conducts diplomacy. He will try and work with allies, not against them. All of that will feel more normal. But ultimately, the U.S.'s, I think, basic attitudes with respect to globalization have changed. We're not as supportive of it as we've been in the past. Biden's been very clear about that, and I think that is something that could catch people by surprise. I would note that just last night, Jake Sullivan, who is going to be the national security advisor under Biden, put out a tweet that was very critical of China and Hong Kong. And I think that is an indication that those who are looking for and hoping for a reset of U.S. foreign policy, specifically with respect to China, but more broadly on trade issues, I think people need to be patient. I think it will be better. I think it will happen over time. But I think that is another area where there is the potential for people to be disappointed. Those are the two ones I would highlight.
I want to ask you two more questions. One is on the immediate risk events for next year. We've talked about Georgia. I've asked you about the potential surprises from Joe Biden. The other one's on the data as well. We've got the non-farm payrolls coming up for the December data. It comes out in the first week of January. We've had some awful numbers in terms of coronavirus cases making historical highs. We're having hospitalizations increase in America. We're having daily death counts make historical highs. That surely should be weighing on the potential for that number. What's the view there, Lewis, for that non-farm payrolls for December's number?
So, we still don't have all the sort of weekly data that we use to make our final forecast, but there's no question that things have slowed. You saw that in the report for November, which we got last week. There clearly is the potential, given what's going on with coronavirus, given the fact that the fiscal support that we put in place in the spring is waning already, for that to slow notably. And we could certainly get an outright decline in employment in that report we're going to get in early January. That's certainly possible. So I think the U.S. outlook at this moment is in a very unusual position in the sense that there's a lot of things that are very negative in the short run, but the prospect of vaccines that are effective turning around spending later in the year means that the further you look out, I think the better the outlook looks.
Well, I want to ask you about that outlook, actually. I want to ask about your view on growth and inflation. We talked about a few things here. So assuming that Joe Biden doesn't win or Democrats don't win Georgia, so we have that sort of fiscal stalemate. I was asking what your team earlier for a couple of key dates that would matter next year. And we've got July where the debt ceiling suspension needs to be renewed. So there could be a debt ceiling standoff mid-year, so around July. And we've got the highway bill expiration in September, the end of that. So the potential for an infrastructure bill to be tagged onto the renewal of that. So you've got the July debt ceiling. You've got the potential for an infrastructure bill in the second half of the year. So how do you square the circle? You've got this back to normal trade, the vaccine trade, the everything rally trade, economic expansion, reopening hopefully from the spring. Fingers crossed this is the last winter of lockdown. But then you've got this debt ceiling and this fiscal standoff. So what's the growth number? What's the inflation numbers you expect next year, Lewis?
So we've got growth in the first half of the year coming in at around 1%, but accelerating to 3.5% or so in the second half of the year. And that really reflects more than anything else the essentially reflation of consumer spending into the sectors that have been so badly affected under COVID, as well as we're counting on getting some fiscal support.
It's smaller than I thought, Lewis. That's the numbers are. I thought we'd get something like 5 to 10%, given it's a reopening. What's the logic there?
Well, there's definitely upside risk. So partly what I would say is we're still dealing with fiscal drag in that outlook. So part of the reason it's not stronger is because of the lag negative effects of all the fiscal support we've had in the past. So it's hard to overstate how huge fiscal support was this year earlier. And we are not going to come anywhere close to replacing that. Just to give you a sense of the order of magnitude, our fiscal deficit in the second quarter alone was $2 trillion. There's no precedent for that. It's 40% of GDP. The bill we're going to get in the next couple of weeks is going to be $1 trillion, but it's going to be spent. It's going to be spread out probably over the course of a year. And so the negative effects of just sort of moving beyond that fiscal support is partly what we think is going to be restraining activity as well. The other thing I would say is it is going to take time for all those beneficial effects of vaccines and whatnot to play out. You're already starting to see a debate around, okay, the vaccines are here, but just how much are we going to get? What share, frankly, of global production is going to end up in the U.S.? And I think the people who have in some sense been most optimistic about the outlook have made pretty strong assumptions about the share of global vaccine production over the next 6 months that's going to come to the U.S. And so once you start like adding all those things up, yes, there's going to be a rebound, but it is going to take some time.
So does that mean inflation's not much of a risk then for the US, given that fiscal drag?
Very much so. So we have inflation coming in at about 1.5% this year, and we think that's going to persist into next year as well. One of the things I would emphasize is rent is very important in this. Rent is one of the most cyclical components of inflation. And we are facing a very serious set of problems going forward, in part because we've had a kind of moratorium on evictions. You've got a lot of people who've had real big financial shocks who haven't paid their rent. Those protections are not going to last forever. And as that happens, you're going to see significant downward pressure on rents. And that is going to show up as weak inflation overall. So that is very much what we're expecting.
Any surprises that we could expect to see from the Fed next year, or is it just the same old?
So I think with respect to short-term interest rates, they've laid out a set of forward guidance that has them on hold for a long period of time. I don't think that's the place where we're going to get surprised. I do think the Fed is actively thinking about its balance sheet. I think they are concerned about being in a position where they have just a sort of an open-ended program of asset purchases. And at some point in the not too distant future, they're going to give us some guidance about how long they're going to continue those asset purchases. as you may remember in 2013, when the Fed transitioned out of a open-ended asset purchase program and started to give the market some guidance on when those things might end, it did not go well. That was the so-called taper tantrum. That experience, I think, will help the Fed manage it better, and I'm not expecting an exact repeat of that. But I do think that is the challenge for them next year, is to lay out a medium-term strategy for their asset purchases that is consistent with their own views on where they want the balance sheet to be, but is also mindful of how markets are going to react. That, I think, is going to be the big issue we're going to face.
Well, let's bring it to Europe now. With me is George Buckley, our chief UK and Euro area economist. George, we're recording this before the ECB this week, the European Council meeting as well. So instead of focusing on those near-term risks and talking about what that means, by the time people are hearing this, they'll have been over and done with. So I want to focus more on the views for 2021 and what sort of events, risks, and outlook we should have. First off, let's talk fiscal policy. It's been a massive year for Europe with all the fiscal spending we saw. Now, there's the potential for the vaccine to also really matter as well for the reopening of the economy. There's just so many moving parts, though, given the situation with the European Recovery Fund and so forth. So what is the outlook next year for fiscal policy on the national basis in the EU?
Hi, Jordan. Well, yes, there's a lot of interesting things to talk about there. And in terms of fiscal policy, you mentioned and touched upon this recovery fund. Well, that's going to be worth around about 5% of GDP. But of course, that's 5% of 1 year's GDP, and it's going to be stretched out across quite a number of years. So the impact is going to be relatively limited. I think what's much more important about the impact is that we have debt mutualization. And that is a much bigger effect than simply the numbers themselves. As for national fiscal policy, I think it's going to be very difficult for governments to announce significant expansions of fiscal policy next year. That said, we're not going to see austerity. We're a long way from that. But I think we're at a midpoint, if you will, between last year, or 2020 itself, which was a significant year for fiscal easing, and probably 2022 and beyond, which is going to be a fiscal tightening. But 2021 is going to be something in between, neither tightening nor loosening.
Well, let's talk growth then. The fiscal policy will feed into that, of course. Monetary policy will feed into it. Then you've got the vaccine and reopening. Do you remember earlier this year, we had the big debate just about V-shaped recovery, U-shaped recovery, W-shaped recovery. I think the Nomura view was a Nike tick-shaped recovery. George, how long will it take for output to make it back to the pre-virus levels? What will that shape look like? And I guess more importantly, which countries are likely to outperform and underperform in this recovery phase?
So I think it's going to take a long time before GDP gets back to a level which resembles what it did before the takeoff point in the end of 2019. I think we're talking the end of 2023 for some countries. But for most countries, I think you're looking at maybe 2 or 3 years from now. And some countries are going to outperform, some countries are going to underperform. Now, some of those countries, like Germany, for example, it has a much larger manufacturing base. Now, manufacturing has weathered this storm very well. We've just seen some very positive manufacturing numbers for the month of October, just published this morning as we speak. And that suggests that the recovery is doing reasonably well. Germany never actually saw a sizable decline in GDP in the first place. And that's probably because it's not as exposed as countries like Spain to things like tourism, to the proportion of people who are employed in arts and entertainments in Spain is much higher than most European countries. So you've got to bear these things in mind when thinking about the recovery process. That said, if you think about what parts of the economies are going to do well as and when the restrictions are lifted, you can possibly imagine that Spain might do reasonably well in the recovery phase, because all of that output, which is being lost before, is going to recoup during the rebound.
Let's talk a bit about the impact that growth outlook will have on inflation. Now, each one of us has a different inflation basket. You and I talk about this quite often, about the price of a beer, for example. One thing I have noticed is during these sort of reopenings we've had, where you actually can go to the pub, it seems like the cost of doing business for most of these firms has increased. You've got to adhere to COVID-19 rules. You've got to have a restriction on how many people you can serve. And so the cost of doing business are certainly higher. Then there's the issue for firms as well, where they've taken on an extraordinary amount of debt to get them through this crisis. They'll eventually have to start paying that back. So the price of a beer, George, it seems to have crept higher again due to all of these factors. I want to talk more broadly about inflation rather than beer, though. I want to ask you, what's the outlook for European euro area inflation next year? Is it higher like the beer story, or is there the situation with unemployment rising that could weigh on things next year?
Well, inflation, of course, at the moment is negative. I mean, we are looking at minus 0.3 at the time we're talking now. It's November figures, minus 0.3. So we're still in deflation at the moment. But it won't be long until that deflation reverses and we see substantial inflation in the next few months, or at least a substantial rise in the rate of inflation. Now, we think that we're going to go from minus 0.3 currently to around about 1.3 in a year's time. Now, we shouldn't think that this is an underlying fundamental recovery in the rate of inflation and that things are okay. Rather, this is a rebound which is generated largely by base effects. If you think about some of the things which have happened over the course of the last year to push down on inflation, they have been to some extent temporary. You've had, for example, the German VAT cut, which probably takes about 0.2, 0.3 off the rate of euro area inflation. That'll reverse at the start of next year. You'll start to see German inflation creep up. You will see energy prices, as long as they don't fall like they did at the start of 2020, then that will mean that you see a significant rise in the pace of inflation at the start of next year. So there have been some one-off effects which are likely to reverse and push inflation back up. But then the big question is, does it continue to rise? Does it even stay at the level of 1.3 thereafter? And I suspect the answer is no. If you look at consensus forecasts, you look at our forecasts, we think that inflation actually might go back down again from the 2022 and beyond. And that's because you've got exceptionally low demand. Now, of course, there has been a supply hit this time, and that's what a lot of people are worried about. Is that going to generate the sort of inflation that we've seen on past occasions when you've had huge amounts of monetary support, fiscal support, like we did, for example, after the two world wars? And I suspect it won't, but I can understand where those risks are coming from. But I think more likely is that we go into a situation where the ECB finds it very difficult to push inflation upwards. And I suspect that, therefore, we are in this for the long run, that inflation is not going to go substantially higher, and that the price of that beer is probably going to stay reasonably low.
It's important. I think the theme of the first half of next year is reopening. There'll be folks who disagree with your view, George, and they'll think that the hit to the supply side of the economy will lead to inflation running away. And so the first half of next year is going to be testing everyone's assumptions on that, and we'll only know the answer possibly by the second half, and dare I say, into 2022. Well, George, thank you for that. And with that, it's a wrap.
Thanks, Jordan.
So those are the views from us, those are the trades from us, and that's the fireside chat with Rob, Lewis, and George. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one. And please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.